All right. Welcome back. It's the Avid Investor Podcast with me, your host, Josh Adamek. And today we're going to talk about investing in rental properties. So, if you listen to the previous episodes, we covered different strategies on how to become an active investor and how to build your own portfolio, different strategies on how to do so. We covered wholesaling. We talked about retailing, also more commonly known as flipping. And today we're going to talk about investing in rental properties. So here goes. When you're looking at real estate, when you're looking at getting started in real estate, in my opinion, you sort of got to hone in on one strategy. Not to say that you shouldn't take part in other investment strategies, but you should really focus, action, repeat. Find one thing, learn that model, invest in that model, grow that model, stay focused. And sure, you can do other aspects of real estate, but if you get caught up in a little bit here, a little bit there, a little bit there, you're not becoming a master of your craft. You're not staying focused. You're not taking action. You're not repeating the process. So in order to get started in business, again, in my opinion, you should pick one strategy out of the gate. Do that strategy over and over again. And, whether that's wholesaling, whether that's retailing, whether that's flipping, in time, once you understand the business and learn the business, sure, when those leads come in, you can figure out the best exit for those leads. And if you're an active if you're an active rehabber, if you're an active flipper, and a rental property, a rental type property comes into your in through your lead generation, sure, you can wholesale that property to a landlord. Or if you're a wholesaler and a property comes into your lead generation, sure, if you have the resources available, you can add that one to portfolio, or maybe you can you can take on the rehab, the renovation. But in my opinion, when you're just learning the business, you should pick one thing and really do it very, very well. Again, when I started in the business almost 20 years ago, my focus was rentals. That's what I did for the first 6, 7, 8 years. This was before we adopted the private equity model. This is before I was a builder and developer. This is before I was doing a lot of remodels. I was buying rental properties because I was doing it part time while I was working a full time job. So that strategy allowed me to focus, allowed me to dedicate what little free time I had to my rental portfolio. So, and when you invest in rental properties, there's a lot of moving pieces. So, but what you should do, in my opinion, again, is hone in on that one strategy, learn that one strategy, and then in time, after you've mastered that strategy or got your portfolio to where you want it to be, take part in the other strategies, monetize those leads as they come in, work different angles. But out of the gate, let's focus on one thing. And let's say that one thing you want to focus on is building a rental portfolio. A lot of people invest in real estate part-time to supplement their income, to create something for the long term, to build up for retirement. Not everybody has the goals or desires to go full-time in real estate. Not everyone has the need or the want to go full-time in real estate. And if you're just looking to supplement your income, you're looking to create something for the long term, you're looking to supplement your retirement or create your retirement, rentals are a great way to go. Some things that you should look at, when investing in rental properties or, creating a rental portfolio. One is property type. What properties do you want to invest in? What makes sense for the long term? In my opinion, stay away from the low income Section 8 type properties. If you're looking at long-term plays, those type of properties, absolutely, there's money to be made. And absolutely, there's people that do, low income properties on a large scale and have large portfolios. yes, they tend to kick off, or they can, if properly managed, they can create more cash flow because your basis is in the property is much lower in comparison to the rents. However, they require more management for the most part. There's more day-to-day management. You tend to have more turnovers. From my experience, the turnovers cost a little bit more, sometimes much more. And there's some downsides along with some upsides. And then not to mention, property values. If you're investing in low income areas, low income properties, you're not going to have the appreciation and the growth that you're going to have in a different property type for the long term, over the long term. And if you're building a rental portfolio, it's a long term play. You can make some money up front, you get your tax, but you can make some money on the, not up front, but through the cash flow. You can make some money through there's some tax benefits with owning real estate. And then your big value creation is your equity, your value in your portfolio. So getting that portfolio paid down, paid off, and creating that value. And take a look, what is your long-term goals? What's your long-term strategies? Are you just looking at the cash flow and investing in low income properties, and understanding that if you own those properties for 5 years, 10 years, 20 years, you may end up selling them for what you paid for them, some maybe less, maybe a little bit more. Again, that depends on market cycles. But if your strategy is long term, if you're looking to create something for retirement, to create real value, you might want to step it up a little bit from the low income Section 8 properties. So, and now I'm just talking about residential real estate, but if you're going residential real estate, you got your low income type properties, you got your, what we invest in, regular houses, regular neighborhoods, which we consider, we call B class neighborhoods, which is median price points for the Pittsburgh market, in that $150,000 to $200,000 range. You have your higher end markets. Some people like to invest in build a portfolio of higher income properties, higher value type properties, single family homes. Again, in my opinion, what we invest in is right in the middle there. Regular houses, regular neighborhoods. That's where we build our portfolio. And why do we do that? Not subject to market cycles. In Pittsburgh, there's always a need. There's always a demand for, a regular house in a regular neighborhood. We look at it as grandma's house. If you're from Pittsburgh, like I am, it's likely, where your grandparents raised their family. It's where my grandparents raised their family. 2-3 bedroom brick Cape Cod ranch, 2-story, whatever it is, worth $100,000 to $200,000. Regular houses, regular neighborhoods. That's what we invest in. If you're investing in higher dollar properties, higher price points, assuming you have the right capital stack and you're not over leveraged on those properties, you have a plan to pay them down quick as the rents are coming in. You can create some real value in the higher dollar markets. Some things to watch for is, the higher dollar markets are subject to market cycles. The higher dollar markets, they may, the cash flows might not make sense because you're going to pay more for the property. You're going to invest more to renovate the property. You're going to have to charge a higher rent to support all of that. And it may not balance out. When you get into the higher price point properties, your turns may cost more. Not that the homes get destroyed by any stretch of the imagination. They can, absolutely. But when you have a bigger home, with more amenities, more features, somebody moves out. I mean, it just costs more to paint a big home. Assuming it needs painted, it costs much more to replace a kitchen. It costs much more to replace a roof on a big home as opposed to, your 1,200 square foot, brick ranch or 2-story. So, there's a number of reasons why we stay right in the middle there. Highly recommend that. You can buy solid properties that cash flow, that provide real value, that provide appreciation and growth over time. So pick your property type, pick your strategy, and that again, that's just residential real estate. We invest in single family homes. Again, we invest in single family homes for multiple reasons. Some of those reasons are multiple exit strategies. We can continue to rent those homes. We could sell those homes on the open market. If we have 10 homes in portfolio as opposed to a 10 unit apartment building, in my opinion, they're better quality assets. They're better for us to manage for the long term. We typically have tenants or residents, as we call them, stay longer in a single family home as opposed to more transient tenants in an apartment building. When we purchase the single family homes, we're helping someone to solve their problem. We're typically buying distressed homes that are a problem property, whether they're in need of repairs, whether there's some financial issues with the seller that we're helping to solve. We buy some estates, we buy some pre-foreclosures, we buy some bank-owned type properties on the single family side. Not to say that you can't do that with apartment buildings, but more commonly with apartment buildings, those are investor to investor purchases and sales. So, a lot of regular people don't own 10, 20, 50 unit apartment buildings. Those are held by, real estate investors. And they're sold based on the financials. So depending on where you're at with the market and the condition of the property and the management of the property, if you're investing in multi-unit properties, absolutely you can get deals and you can get opportunities. You can get value add opportunities. We just find that our go-to strategy is regular houses, regular neighborhoods, single family homes. So you've got your single family homes, you've got your apartment buildings. Of course, there's commercial, there's self-storage. There's a number of different investment types, property types that you can invest in, to create a portfolio over the long term. I do own some commercial properties, not a lot, but that's not what we do. It's just, some opportunities that I've had over the years. But I'm not one to teach or tell you about, investing in commercial real estate. I'm a residential guy. I'm not one to teach or tell you about self-storage because I don't invest in self-storage. I have some friends that invest in self-storage facilities and they do very, very well. I know there's a lot of opportunity in self-storage. Again, those are investor to investor transactions. You have the opportunity to, buy existing self-storage facilities, maybe that have a value add creation. You have the opportunity to, develop a self-storage facility. I mean, you have the ability to, develop any type of, long-term investments for your portfolios. I've seen, that right out of the gate, it's probably not something that you want to get into, getting a piece of land and, building an apartment building or getting a piece of land and, building a self-storage facility or, building a group of, a neighborhood or a community of single family homes. There's a lot of moving pieces when it comes to new construction and land development. Do people do it? Is it a strategy that's done? Yes, absolutely. Typically, it's a strategy that's done by investors or groups of investors that have an abundance of financing and resources available. So if you're just starting in real estate, if you want to be an active investor and manage your own portfolio, in my opinion, you want to focus on existing properties, lower barriers to entry. Buy some single family homes, buy a small apartment building, buy a duplex. My first purchase almost 20 years ago was a duplex. So it worked out very well. Still own the property today. It performs well. I'm not knocking multifamilies by any stretch of the imagination. I own some and have some in portfolio. I've owned some, apartment buildings over the years that, we've exited in different market cycles. So there was a little bit of value creation and some money to be made there. I don't hold apartment buildings in portfolio. I don't actively look for apartment buildings. Again, we keep the blinders on, try to keep the blinders on for the most part. Regular houses and regular neighborhoods is what we invest in. So you got your property types, figure out what you want to invest in, figure out what your goals, what your desires are, what you want to create for the long term. Pick your property type. You got to finance the purchase. So assuming you want to be an active investor, assuming you're not, sitting on millions of dollars liquid, and if you are, you may want to monetize that through increase those returns through different funding resources. So assuming you're like I was when you started in real estate, and you have little to no money, there's financing available. So you can there's asset-based lenders that are hard money type lenders. There's, banks are lending right now on investment type properties. If you're going institutional financing, bank type financing, you're going to need some cash. I mean, if you're going with a hard money type lender, that's an asset-based type lender, you're probably still going to need some cash, some money to put into the deal, depending on the deal and the terms that you lock up, that you have available. But different financing types, there's the hard money lenders, there's of course banks, there's private lenders that you can work with. You can create a partnership. We operate under the private equity model, where I'm going to dive into those details in probably the next episode here. So if you want to learn more about how we fund and how we create our portfolios, the benefits that we provide to our investment partners, I'm going to dive into those details. But you're going to need your property type, you're going to need your funding. So buy your property, get your funding in place, or secure your property, get your funding in place, or get your funding in place, secure your properties. Everybody has a different take on that. And I know, when you're purchasing your properties, you're going to want to make sure that you have some equity out of the gate. I would highly recommend against, over leveraging your properties. And it's not that difficult to do in the Pittsburgh market, where you buy in the Pittsburgh market and many other markets, where you buy a home or buy an apartment building, or buy a self-storage facility, or whatever you want to invest in. Sure, you got to look for those. You got to spend the time, effort, and energy to find those deals. But you want to make sure that you have some equity, so that your investment is safe and secure, and also cash flowing. We look at, when we buy single family homes, a absolute max of 70% of the after repaired value, all in. That's purchase, that's renovation, that's transactional cost, all in 70% max of the after repaired value. So we look for 30% equity when we're building our portfolios. And reasons why you should do that is, one, you don't want to be over leveraged. You don't want to have, too much cash, too much money tied up into one deal. If you over leverage the property, that's going to drastically affect your cash flow. And then two, if you're over leveraged on the property, it's risk. It becomes a risky type transaction. If you're buying these homes, 90, 100% of value, and you're banking on, appreciation, that might not be there. But if you got that, 20, 30, 40%, equity built into your property, you have real value. You've created real value. And your cash flow should be in a good spot. Your equity's in a good spot, and assuming the market, the market continues to rise, that equity will continue to grow. Assuming there may be a dip, there may be a correction. Yeah, sure, that value of that asset might fluctuate, but your cash flow is going to be there. Your cash flow is going to support the property. So make sure that you're buying right. Again, I recommend, 65, 70% max LTV. LTV is loan to value, or, all in to value, however you want to look at it. You might not have a loan against the property if you're buying these all cash, or if you're doing, a partnership, an equity model, private financing type model. So, you've got your property type, you've got your financing in place. Now you got to manage these properties, and the key to a long-term portfolio is proper management. You have to manage these properties, and then going into this business, you should have some goals. You should have some strategies. How big of a portfolio do you want to build? In my opinion, you should self-manage your properties. Are there property managers out there that do a good job? Yes, absolutely. However, there's a cost associated with that, and property managers are fee based. So, each time the property turns, it costs money. Each time there's a repair, it costs money. There's costs. There's big costs associated with management. And let's be honest, if you properly dedicate your time to your portfolio, to your vision, to your strategies, nobody's going to manage that property better than you. And I'm not knocking property managers. I know a lot of property management companies. I know there's some really good ones out there. I also know that there's some that are not very good. And not going to get into recommendations. Again, if you're looking for a property manager, you know, check reviews, check with other landlords that have properties in portfolio with them. A good resource to find a property management company. Again, not to beat a dead horse here, but join your local RIA. RIA is Real Estate Investors Association. There's property managers that are vendors at your local RIA in Pittsburgh. I'm a part of Acre of Pittsburgh. That's our local Real Estate Investors Association. If you have a burning desire to work with a property manager, I know there's some property managers there that have done really well for some of their clients. But look at what's your strategy, what's your vision. If you're going to buy rental properties, if you're going to have financing in place, if you're going to look to refinance these properties and take your cash out of that home, still keeping it at 70% or lower, you're looking to recoup your cash to buy more properties. If you got financing against the property, you got taxes and insurance, you got vacancy, you got some repairs, paying a property management fee on top of that really takes away from your cash flow. So, if you go back to a previous episode where I talked about how to become a millionaire in real estate, how to build, a real $1 million portfolio. If you're going for that rapid pay down on your properties, those property management expenses are going to take away from that rapid pay down. So, what's your vision? What's your strategy? Are you going to self-manage these properties? Is your goal to, build a portfolio of 5, 10, 20, 25 homes to where you can self-manage these part-time? And yes, absolutely. If you're investing in the right property types, you can self-manage 10, 20, 25 or more homes in, a reasonable amount of time. It does require work. It does require time. It does require effort and energy. But you can self-manage those portfolios. Is your goal to build a much, much bigger portfolio where you're going to get 50 or 100 or, a couple 100 homes in portfolio? If that's the case, over time, I would still recommend, self-managing those properties. But, like we've done at AVID Management Group, is we've created our own in-house management company and management team. So, we manage the portfolio in-house. That's something that you can do over time when you've built up a large enough portfolio where the revenue from the portfolio, supports adding members to your team. But that's a big key, a big part of the portfolio process is management. Management is huge. I mean, if your properties are mismanaged, you can go out of business real quick. If your properties are properly managed, you can really, really increase those and keep those revenue streams where they need to be. So we talked about, property types. We talked about, funding and financing the properties. We talked about management. We talked about, how big. Again, what are your goals? What are your desires? Where do you want to build how big of a portfolio do you want to build? Is it 10 homes? You can do very, very well with 5, 10 homes. You can do very, very well with 25 or 50 homes in portfolio. But that needs to be your goal. That you need to identify your goals and your desires. As you're getting into this business and as you're growing, what are you looking to do here? Are you just looking to create something to supplement your retirement? Are you looking to create something to help put your kids through school? Are you looking to create something to to pass to your kids in time? And two, how much time do you have available to dedicate to this model. If you're if you're going to be an active investor, meaning you're going to build your own portfolio, you're going to create your own portfolio. You're starting like I did with very little money and resources, and you're looking to create something. It requires time, it requires effort, and it requires energy. I spent first 7 years, 8 years of my career investing in real estate part-time. And then I made the transition in 2010 to go full-time in real estate. Not necessarily because, the real estate had replaced my income. It was more so, personal decisions or things going on with my family. As I mentioned, my wife was sick at the time, and, I had to free up some time. So that was my decision. But my rental portfolio didn't support, eliminating my full-time job. So I had a portfolio built. And when I went full-time in real estate, I started buying and selling a lot more. But again, I had spent that 7-8 years learning the business, understanding the business, building the resources, building the connections to make that transition full time. There's a lot of people. I come across a lot of people, at Acre, at our local RIA, and just being in the business in general, that people say, "Oh, I want to be a full-time real estate investor. I want to be a full-time real estate investor." And I did. I wanted to make that transition, almost day one. Some recommendations on that that I've gained from my mentors over the years, in my early years, is you want to be prepared to make that transition. You have to understand, if you're leaving a full-time job and you quit that job and go full-time in real estate, your paycheck goes away. Your healthcare goes away. Your comfort goes away. You're not getting a paycheck every 2 weeks. You now have to pay for your health care. If you have 401ks or retirements through contributions through your employer, all of that stuff goes away. Not what you've built up, but all those benefits, all those things that are offered by your employer, they go away. Now, I'm not saying you shouldn't go full time in real estate. I did, and for me, it was the best thing that I ever did. But when I made that transition, I felt I was ready. I felt I knew enough about the business to make the transition. One recommendation that I had from my mentor at the time was, don't go full-time in real estate until you have 1 year's salary in the bank. And why is that? Because when you make the transition, from, working a full-time job, part-time real estate, to full-time real estate, or any type of business for that matter, that paycheck goes away. If you have 1 year's salary in the bank, you can still continue to, pay yourself weekly, biweekly, monthly, whatever it is, and, have that comfort. You have, a 12-month runway ahead. That's one recommendation from a very good friend and mentor of mine, is have that nest egg build up, or have your cash flows from your rental properties up to where your cash flows, your passive income far exceeds your monthly expenses. And you've created that paycheck, that value, that replacement for your paycheck, for your comfort, your safety, your security. That's it, and maybe we'll dive into that in a future episode, is making the transition from part-time to full-time, more tips, tricks, and strategies. But if you're going to do, if your goal is to build a rental portfolio for long-term, and get to the point where you can live off those cash flows, again, in a previous episode, we talked about how to buy 10 houses, one house a year for 10 years. Year 20, that portfolio is paid off. Maybe you want to make that transition quicker. Maybe you don't want to work your full-time job for 20 years. So you got to speed up that process. You got to buy more than one house a year. But the big thing is, getting that debt paid down, increasing that cash flow, investing in real properties, that have real value in good neighborhoods. Again, you can take a look at low-income Section 8 properties. There's some people look at it as it is, there's some upside there. A lot of people look at it as there's some downside, there's a lot of risk, and there's not real like value creation there. So pick your property type, pick your strategy, focus, action, repeat. That's how you build, that's how you can build your rental portfolio over a period of time. And the amount of time that you have dedicated to investing and to building that portfolio will dictate, how large your portfolio gets, and how quick your portfolio gets there. So that's it. Thank you for tuning in. I appreciate this. Again, I'm not asking for anything in return other than, if you find value in this message, if you think someone else can value from the information and the content that I'm providing here, just share it. Share it on social media, grab the link, text it to a friend, email it to a friend, share it with a group. That's all I ask for in return. So thank you and have a great day.